Refinancing with poor credit is not only possible, but every borrower has various possibilities. Bad credit doesn't mean you're stuck. It simply means you need to look deeper for a solution. Continue watching to learn about a few helpful choices for refinancing your loan, even if you have bad credit. Every borrower considers mortgage refinancing at some point. Because the mortgage is the most expensive cost for most homeowners, it makes sense to start there when looking for ways to save money. Fortunately, there are solutions available to you when wanting to refinance with poor credit, potentially saving you money each month and positioning you for a more successful future. Here are the 8 mortgage refinance options for borrowers with bad credit. 1. Try your own mortgage lender first. Mortgage lenders prioritize building relationships with borrowers. If you have low credit and want to refinance, you should start with your current lender or loan servicer because you are currently a customer. If you have a mortgage with a financial institution, contact the original contact person, if they are still there. If not, get a referral to a specific person. Having someone's name and something in common, such as the referral source, is a good way to begin building the relationship. Explain your requirements and learn about the possibilities available to you from the bank. You truly desire the benefit of the doubt. If a lender considers your debt-to-income ratio and loan-to-value ratio, among other things, and your application falls into a murky area, it can go either way. You want a yes, and if you have a relationship with the lender, such as checking or savings accounts, that may work in your favor. 2. Check out an FHA Streamlined refinance. If you wish to refinance and have an FHA loan, the FHA Streamline program may be a good alternative for you. According to the U.S. Department of Housing and Urban Development, the average credit score for a borrower who refinanced an FHA loan between October and December of 2020 was 666, with a minimum credit score of 580 required. Borrowers with credit scores as low as 500 but home equity of 10% or more may be eligible for refinancing. 3. Explore an FHA rate and term refinance. While an FHA Streamlined refinance is only available to existing FHA borrowers, any borrower with a high interest rate may benefit from an FHA rate and term refinance. This process involves more paperwork. A new appraisal and a credit check are almost certainly necessary, and the mortgage being refinanced must be current for the month due. An FHA rate and term refinance, like the Streamline program, is not a cash-out program. The goal is to assist you to lower your monthly housing costs. All funds must be utilized to pay down your existing mortgage and transaction expenses. However, this procedure allows for the inclusion of second and third mortgages in the refinanced amount. 4. Apply for a VA Streamline refinance or VA-backed cash-out refinance loan. If you already have a VA-backed home loan, you can refinance with a no-hassle interest rate reduction refinance loan, also known as a VA Streamline refinance, even if you have low credit. This normally demands financial information such as 2 years of W-2s, federal income tax returns, and recent pay stubs. This option is only available to lenders who require a house appraisal. In recent years, the VA has modified interest rate reduction refinance loan rules to ensure the refinance makes financial sense for qualifying veterans. In order to be eligible, homeowners must have a minimum amount of seasoning on their current loan. That usually implies you've made at least 6 monthly mortgage payments, though other lenders have even stricter seasoning requirements. If you are a veteran with a non-VA loan, a VA-backed cash-out refinance loan allows you to replace your current loan with a new one while taking cash out of your home equity. Even if you don't wish to take cash out, eligible veterans who have a current mortgage with a lender other than the VA might look into refinancing through this program. 5. Use the USDA Streamlined Assist Program. If you qualify, the USDA's Streamlined Assist program may be the best alternative for a refinance with negative credit because there is no credit check. Instead, anyone with a USDA loan or one supported by the USDA who has paid their mortgage payments on time for the last 12 months is eligible. This program does not require a new appraisal or home inspection and does not consider your debt-to-income ratio when establishing your eligibility. As with other Streamlined programs, there must be a minimum outcome. In this case, a $50 net reduction in monthly mortgage payments. 6. Consider a portfolio refinance loan. A portfolio loan is another option if you have terrible credit. A portfolio loan, so named because it is held by the original lender rather than being transferred to other companies, can be obtained through banks and mortgage brokers who set their own loan rules, which can be more flexible than usual refinance requirements. If you've been a long-time bank or mortgage customer, or if the lender wants your business, you're more likely to acquire a portfolio loan. However, this does not imply that lenders will finance any borrower regardless of qualifications. They still want portfolio loans to perform, which means they will scrutinize your money and credit history. If you've encountered an application issue that hasn't been resolved with most lenders, a portfolio lender may be more accommodating. Smaller borrowers are catered to because they are their specialty or major customer base, and they are looking to expand their portfolios of small lending. Smaller borrowers often have greater growth potential, and the more money a business makes, the more money the lender makes. Work with a mortgage broker or a full-service mortgage lender to shop your application to portfolio lenders to see whether one is accessible to you. 7. Find a CoSigner. If you have weak credit and are unable to refinance and lock in a reduced rate, there is one technique that can instantly improve your situation: becoming a cosigner or co-borrower. A cosigner with good credit and significant resources provides extra protection to the lender, but co-signing a mortgage is a commercial transaction even among family or friends. Co-signers worked hard to earn their money and credit, so you'll have to persuade them that you have the financial means to repay the loan and that you'll prioritize repayment over other responsibilities. Late payments affect both borrowers' credit records, and if the loan is not paid on time, the co-signer is held accountable, and the lender will look to them for any shortfall. 8. Work to improve your finances and credit. It's critical to think about ways to improve your credit as you explore your refinance choices with bad credit. If none of the above refinance choices work for you, you should take a step back, assess your total financial condition, and make the changes to improve your financial well-being. Well, we often heard that, should I refinance with bad credit? If you have poor credit, you may be wondering if you should delay refinancing. If you can refinance today, it's worth thinking about. Why? It could be a crucial step in converting bad credit to excellent credit. You can reduce your payments. If refinancing lowers your monthly mortgage payment, you'll have more money in your budget to pay off other liabilities or put into savings. Mortgage insurance could be eliminated. If refinancing requires a new evaluation of your house, you may discover that its value has grown. If the value has increased to the point where you have 20% equity, you may be able to discontinue paying mortgage insurance. You could save money in the long run. There is no perfect answer as to when to refinance because several things come into play, but refinancing can save you a significant amount of money over the duration of the loan. While refinancing can save you money, keep in mind that it also costs money. To ensure that refinancing is worthwhile, account for all costs, even if you have bad credit.